Now let's get started. When we talk about fiscal policy, we talk about two main aspects. On the one side, that's government spending, and on the other side, that's taxation. While government spending implies a direct shift of the aggregate demand curve, taxation does only shift the aggregate demand curve in an indirect way. So let's start with government spending. When we talk about government spending, we have to keep in mind two aspects. On the one side, we have the multiplier effect, and on the other side, we have the crowding out effect. Now let's begin with the multiplier effect. The multiplier effect is the additional shift in aggregate demand that result when expansionary fiscal policy increases income and thereby increases consumer spending. Let's say the increase in government purchases of 20 billion initially shifts the aggregate demand curve to the right. However, because each dollar spent by the government can raise the aggregate demand curve for goods and services by more than $1, government purchases are said to have a multiplier effect on the aggregate demand curve. That is, the aggregate demand curve shifts even more to the right. We can calculate the multiplier effect with 1 divided by 1 minus the MPC. The MPC stands for marginal propensity to consume. Marginal propensity to consume stands for the fraction of extra income that a household consumes rather than saves. For example, suppose that the marginal propensity to consume is 3/4. This means that for every extra dollar that a household earns, the household spends 75 cents, which is 3/4 of a dollar, and saves 25 cents. With 3/4 times $20 billion, which is $15 billion. Summing up, an increase of $20 billion in government purchases is able, with a multiplier effect, to shift the aggregate demand curve even further to the right with $15 billion, given the fact that the marginal propensity to consume is 3/4. The crowding out effect is the offset in aggregate demand that results when expansionary fiscal policy raises the interest rate and thereby reduces the investment spending. When an increase in government purchases increases aggregate demand, the increase in spending increases money demand, as you can see here in this graphic. This results in an increase of the equilibrium interest rate from R1 to R2. This is partly because the income of households increases when government purchases increases. And as income rise, households plan to buy more goods and services and, as a result, choose to hold more of their wealth in liquid form. That is, the increase in income caused by the fiscal expansion raises the demand for money. Because the interest rate is the cost of borrowing, the increase in the interest rate tends to reduce the quantity of goods and services demanded, particularly for investment goods. This crowding out of investment partially offsets the impact of the fiscal expansion on aggregate demand. So back to our example where the initial $20 billion increase of government purchases was able to further increase the aggregate demand curve with $15 billion, leads to a reduced aggregate demand curve. Now let's talk about the second instrument of fiscal policy, which is taxation. Keep in mind that taxation is only able to shift the aggregate demand curve in an indirect way, and not, like government spending, in a direct way. When the government cuts taxes, households will save some of this additional income, but they will also spend some of it on consumer goods. Because it increases consumer spending, the tax cut shifts the aggregate demand curve to the right. Similar, a tax increase depresses consumer spending and shifts the aggregate demand curve to the left. The size of the shift in the aggregate demand curve resulting from a tax change is also affected by the multiplier and crowding out effects. This is similar to the government spending. When the government cuts taxes and stimulates consumer spending, earnings and profits rise, which further stimulates consumer spending. This is the multiplier effect. At the same time, higher income leads to higher money demand, which tends to raise interest rates. Higher interest rates make borrowing more costly, which reduces investment spending. This is the crowding out effect. At the end, let's talk about automatic stabilizers. Automatic stabilizers are changes in fiscal policy that stimulate aggregate demand when the economy goes into a recession without policymakers having to take any deliberate action. The most important automatic stabilizer is the tax system. Let's take for example that the economy goes into a recession. Now what happens is that the amount of taxes collected by the government falls automatically because almost all taxes are closely tied to economic activity. Because incomes, earnings, and profits all fall into a recession, the government tax revenue falls as well. This automatic tax cut stimulates aggregate demand and thereby reduces the magnitude of economic fluctuations. However, in the US, automatic stabilizers are not sufficiently strong to prevent recessions completely. Nonetheless, without these automatic stabilizers, output and employment would probably be more volatile than they are and could shorten the recession.